All right, so let's pick it up here where we left off. We were looking at the code for the binomial option pricing model. Now, this first case we looked at was the European call option, which we were pricing with the Cox-Ross-Rubinstein binomial option pricing model. And we basically went through the whole thing. We set up these matrices, or in VBA, they're called arrays, but we could think of them as vectors or one-dimensional arrays. It amounts to the same thing, where we store the results from building up the stock tree and the option tree. So, of course, the binomial option pricing tree structure doesn't really lend itself well to writing code. So instead, we have to find a way to store it in a way that's more consistent with matrices. So this can be done in many different ways. But here, what we're doing is we have a vector for each time step. And you can see that from the top to the bottom, this reflects the nodes that we've reached when we go up a certain number of steps or down a certain number of steps. And in the case of the European option, we don't really need to store the entire tree all at once. It's enough to have this current time step, and then we can work our way back in time to the present. And so that way, when we're done, all that remains in that vector or array is the price that we're looking for. Okay, so we basically went through all of these steps. We showed the relationship between the stock prices based on the binomial option pricing model. We saw how the code is written to fill up these arrays with prices and then move back through the tree. And we also did the same thing for the option prices, except the option prices are a little bit different because the prices at the terminal time or final time step are just payoffs. It's the interior nodes where it gets messy. Okay. So just, I mean, you see, we did all the examples, but just as a quick review, um, you might recall that if you are, let's say, this is your stock tree, and this is the option tree. This is clearly a two-period model, and that means that the option expires at time t equals 2. So at that time step, its option prices are all actually payoffs, or sometimes they're called the intrinsic value of the option. So on the top, we would have max SU squared minus K0. Because this is a call, by the way. Here you would have max SUD minus K0. And then for the bottom, you have max SD squared minus K0. But once we move inside to the interior nodes, then what we're doing is we're calculating a weighted average of the option prices that we could reach from that node discounted back to the present. So in this example, FU would be right. So in other words, from that node, we can go up to FU or FUU rather, and or down to FUD. And so the probability of going up, of course, is P in a risk neutral environment. And of course, this must be then the probability of a downward movement. So what you're seeing in this expression, the brackets, is the expected value of the option in one time step, because this is from the perspective of FU, which occurs in period or time t equals 1. So you're looking ahead to t equals 2 and taking a weighted average of the two possible values it could have. Given that it's a binomial tree, there's only two possibilities where the probabilities are p and 1 minus p. So you can think of this as an expected value. And now, of course, because this happens one period in the future, the value of the option today has to be discounted by one time period using the risk-free rate of interest. Okay, so since we're using risk-neutral probabilities in the model, all the discount factors or rates are risk-free rates. Okay, so in a risk-neutral framework, all cash flows are discounted using the risk-free rate of interest. In this case, it happens to be um, the continuously compounded risk-free rate. Although it doesn't technically have to be, that's normally how it's done because it's just easier to deal with continuously compounded rates mathematically. So we often see these types of models using continuously compounded rates, but that part is not necessary. But we do have to use the risk-free rate of interest, and that rate is whatever the Treasury bill yield would be for one period at that point in time. So then, of course, we do the same thing for FD, and then we do the same thing for F, and we end up with our option price. Now, this, of course, is how it's done with the European option. So in the code, what you can see what we were doing was we have an array here for the option. Now, this was a 3-period model, by the way, that you're seeing here. We had to go out to time 3 to fill in all these intrinsic values or payoffs, and then one step prior to that, you can see the tree has one fewer node. Yeah, so you can see at time 3, we have 4 nodes. Time t equals 2, we have 3 nodes. So you can see it works its way back. We have one less node at each time step. So one period earlier, we have one less node. So the way we structure that here, at least, is to only use the bottom 3 and then the bottom 2 and then the bottom 1 when we get to the current time. Now, that's not the only way this could have been done, of course, but this is the way it's being done in our book. And it works very well. So now, where we left off, I think we had just started to inspect this part. This is the loop that fills in the interior nodes of the tree, the option pricing tree, that is. And so what's happening here is that we can make this process more efficient by actually doing two things at once. We've got two loops. The top one is for the time step. Within each time step, we're going to look at all of the levels, okay? So, for example, I is time, by the way. So with a 3-period model, we start at time 2, and we work our way back to time 0. So we need this command step -1 to make sure that we're going backwards. Within each of these, the J, now the J, remember, is the index for levels. How far up have we gone? And so the bottom is considered to be 0. That's one of the unusual features about this model, that the bottom of the array is considered to be 0. That it didn't have to be done that way, but the idea is that 0 means the tree hasn't gone up once, not even once. It's all downward movements. So the J is supposed to represent how many times has the tree gone up since we started. If it hasn't gone up at all, meaning we're in the bottom branch, that's what we mean by J equals 0. So if you notice, they very cleverly indexed the J not from 0 to a constant, but to I. And here's why, because within, let's say, time step 2, J will be here, J equals 0, 1, and 2. So it can't go past T. All right. Now I is the index we're actually using for time. On the graph, it's T, but here it's I. So in other words, the number of steps within a given time step can't go past the actual time itself. So then when we move one step back further, you notice here we have J equals 0 and J equals 1. Again, it cannot exceed this one. And then here we simply have J equals 0. So the I keeps track of time. J keeps track of the levels or upward movements since the beginning. And so by going through it, the loop this way, we're going to cover all the possible cases fairly quickly. And if you notice in each case, what are we doing? The option price at that level, J, is equal to, actually, let me go down here and look at this one. Numerically, what we're doing here is saying, let me actually fill in a number here. Suppose we're looking at, remember, this is a 3-period model. So let's say that, sorry, we're we're looking at FU. Now, of course, the graphs are designated FU, U, and all this. We're keeping our information in arrays. So within this time step, we're going to have F0 and F1. Okay. Within this time step, it would be F0, 1, and 2. So if I'm interested in this one, what's actually going to happen is F of 1, let's look at this code for a second and follow through. F of 1 equals the discounted value of P. Now here we have F of J plus 1, which means F of 2 So I've labeled it both ways. So to go here, we're going to go up to F2 or down to F1. And of course, remember, this is what we've been calling FU. This is FUU. This is FUD. So that's what that line is telling me to do. Then it goes to the cycle again. Okay. In other words, it continuously fills in all the nodes. And then finally, when it gets to the end, F0, which would be, let me put it over here. This is the actual option price. It'll be the only entry in the array at time 0 or today. So that's how we know which one it is. So you can see that the command here tells us to take whatever that is and print it out onto the Excel spreadsheet. And that's how we have our price. So let's go look. Let's see, where is it? So now keep in mind too, with only 3 time steps, the chances are that this is not an extremely accurate result. It could be off by quite a bit. So what you can do is, if you want to, we do have code from last semester for Black-Scholes. You could pop it in there and say, well, listen, I want to know the exact Black-Scholes price of this option, just to get a sense of how far off we are. Oh, here it is. It's right here. So what you could do is say, all right, let's take this information and borrow it. Let's see, R is 0.06. Sigma is 0.165. T is 1 year. Okay. So the Black-Scholes price, there it is, 9.7118. Oh, oh, hell. It's off a bit. So what you can do though, you could try some experiments. You could just, what you would do is you change N. Let's say I change this not from, let's say instead of 3, I've got 300. I can run it again. And you can see, wow, that made a big difference. Look at that. It's only off by less than, well, roughly a penny. What if I change it to 500? Oops. Look at that. Well, see now here's, remember, I showed you this graph once before. As you keep increasing the number of time steps, you don't expect the price to converge directly to Black-Scholes. Instead, it tends to exhibit a pattern like this. Kind of like an oscillating pattern where it goes up and down, up and down. It goes too high, too low, too high, too low, too high. But the important thing is that as n gets bigger, these mistakes should get smaller, okay, and smaller and smaller, and converge eventually to the correct solution. Otherwise, the model is worthless. Basically, we have to know that in the limit, this will give us the Black-Scholes price, and otherwise, what are we doing? So, if you kept doing this, if you wanted to try a little experiment and just keep track of everything, this is what you would expect to see. Now, the one thing you also don't want to see is if I increase this again and it gets worse, then we have a problem. Okay. Now that time it didn't change it enough. It was less than the rounding amount. So, but again, you can see we're getting pretty close here. We're less than a penny. And now, if you really need it to be, the only unfortunate thing is that if you need it to be super accurate, like a penny or less, the number of time steps can start to get really large. And so, anyway, um, what's interesting here too is that I forgot to point out that these numbers will change. You notice how with 600 time steps, DT is like 0.001. It's a tiny amount. It's like what is that? A 50th of a month, basically less than a day. And they're all going to be affected. Okay, but they still maintain their properties. The discount factor is 0.9999 because that's the present value of receiving a dollar a day in the future. But the key detail here is that we can tell, how close we're getting just by looking at the Black-Scholes price. So let me put it back to 3. And that's where we should be right now. So it's off a bit, but that's because it's only 3 time steps. All right, now, so what we wanted to do is point out, how do we change this for a European put? Really, there's only the one change. At the terminal nodes of the option tree, the payoffs are going to reflect the fact that it's a put rather than a call. That's the only difference. So in other words, here, guess I can copy these. So what you would do is it would be a simple matter to change these to the payoff for a put. So this one, for example, would be K minus SU cubed, K minus SUD squared D, K minus SUD squared, and finally K minus ST cubed. That's it. That's the only change you would have to make, which is kind of nice. Okay, now the challenging one though is the American options. Okay, now remember, with American options, we have to decide, except at the maturity date. The maturity date is different because on the maturity date, um, well, actually, no, I'm sorry. Even then, it's the same. It's a payoff of some kind. But what's going to happen is every interior node will have to allow for the possibility of early exercise. So how would that work? I have to make an adjustment here. Because yeah, because of the tablet, it's all right. So what to do about American options? So first, let's remind ourselves how this works with the model itself. Okay. All right. So let's say again we have a three-period model. For the options, oh, sorry. By the way, when we're done with this, we're getting pretty close to the end here. We're going to switch over to the trinomial trees, which are not as quite as widely used. They're really meant for more specialized circumstances. Like it turns out they're very useful for interest rate options because they have a little bit of extra flexibility, but they are a little bit more complicated to program, of course. So we'll get to that in a bit. First, we want to wrap this up. And then I think, let me just double check here real fast. We will have Monte Carlo. Now, I tell you, Monte Carlo to me is one of the most exciting and interesting, fascinating areas of study. It is just an amazing area. It really is. You could spend your whole life analyzing simulation methods. And the beauty of it is that it can be used for any situation you find yourself in, any option, no matter how bizarre or how strangely behaved, as long as you're willing to make assumptions about the statistical properties of the underlying assets. Um, but but the unfortunate reality is that it is very time consuming. So we often tend to save it just for special cases. And then when that's done, we're going to look at finite different methods, which are kind of a variation of trinomial trees. And then we get to spend a lot of time with interest rate derivatives, which are very complicated, but very, very important. So we'll get to all this good stuff. Don't you worry. But so the trinomial tree discussion is much, much quicker than the binomial because it's just an extension of the same idea. And Monte Carlo, what an exciting topic. It really is amazing stuff. But um, We'll try not to go berserk with it, but what we will do is we'll introduce exotic options, understand some of their basic properties, and then see how they can be correctly priced with Monte Carlo simulation. Okay. Because that's where they really excel is at exotic options. All right, so that's where we're going. Now, in the meantime, let's get back to this. So I want to draw this graph one more time. Don't forget the subscripts are different with for some reason, this is just the standard procedure. You don't see like U squared and that kind of thing. I think it's just because they're trying to reinforce the idea that this is a subscript over here, this is a multiplier. So of course, at these nodes, the value that we put there is simply the payoff. What about FUU then? Okay, what would you put there? So you have to take into account that there's two possibilities here. Uh, so let's think of this as a let's try this. Let's think of it as a piecewise continuous function, like something like this. And then if now actually, I think I'll write it like this. If European or American, but not exercised early. That would be the best way to explain this. If not, now watch this. Look how easy this is. So I'm assuming again that this is a call. If I exercise it early, I simply receive the payoff. Max SU. Now this node, S is worth SU squared. Whoops. Because we're at time 2, if exercised early. Well, actually, what it should be more specific, if American and exercised early. It can't be a European here. So here's the big question. How do you know when to exercise early? Well, so we're going to assume, first of all, we always assume that the investors are rational, that they're never going to make a decision where they knowingly make themselves worse off. Now, it's not that they don't make mistakes, but they're not going to exercise this option early unless it makes economic sense. What that means is this. The option will be, the call option will be exercised early, only if okay, because the one on the left is the value if exercised, and the one on the right is the value if not exercised. So nobody in the right mind would exercise it unless that provides them a payoff which exceeds the value of a European option, the equivalent European option. Okay, so that's how we decide. So basically, you can make the case that FUU could be written as the greater of the two. Now, we can simplify this a little because if the option is exercised early, this implies that this term is positive. Otherwise, we wouldn't do it. So in other words, what you can do is rewrite it like this. Now, the reason why this matters is because this is how the code is going to be written. Okay, so whichever one is greater, that's the one that it will have. So each node, we're assuming at each node, the option will be exercised if it makes economic sense. So we're going to put this on each node, each interior node. The final or terminal nodes are not affected. Those are just payoffs, no matter what happens. So the question is, how do you modify the code to do that? Well, it's not as difficult as it sounds. There's different ways we could go about it, but this code, which I have right here, if you could look at them side by side, you'd see that there's almost no differences. Let me see if I can find the first difference. The name, of course. No, no. So after initializing everything, so here in this tree, we're going to go out to the end and we're going to fill in the payoffs on the maturity date. And then the tree, um, so basically what it's doing here is this. It's filling in the European value on the option tree for each node. And again, we have this nested, well, actually, yes, here's our nested loop. That part hasn't changed. Fill in the option tree at the terminal date of the option with payoffs. Now, here's one key difference. There's two actually right here. If you notice within the same loop, we're also filling in the stock tree. Okay. Before we didn't need to bother with that. Once we had the payoffs for the option, we didn't need the stock tree anymore. We just filled in the rest directly. But here we do. So every time we update the options, we're going to also update the stock tree within that time step only. So we always have them together side by side. Okay. So in other words, when you're at time step 2, if you remember from the diagrams, at time step 2, we actually have 3 values on each tree. Whoops. Sorry, that's 4. So it fills out in the options, then it fills in the stocks. Now, why is it doing that? Because of the next step. So what it's saying is, listen, this is the European price of this option at that node. Whatever it is, we're going to come down here and say, listen, here's the European value. This is the payoff if exercised early. And so it's just going to say whichever is the greater, put it on that node. So that means if this is the value, that means it's been exercised early. Here, it's not exercised early. So basically, these two lines are the only changes in this program from European to American. Okay, so it's kind of surprising. You'd think that it would be more, sorry, you'd think it would be more complicated than that, but it's not. Okay, so it's the same structure. You just have that one extra step. You need to keep filling in the stock price tree. But other than that, wow, that's kind of surprising. So this is our American call. And by the way, if you want an American put, all you would have to do is when you fill in the terminal option prices, meaning at the maturity date, the payoffs would reflect the fact that it's a put instead of a call. Well, so that's all there is to it. So, all right, anyway, so what I'd like to do is at least take a peek at our trinomial model before it's a little more complicated, I guess you could say, or at least a complicated looking. We need to do a little bit of background before we completely start doing the coding, but you'll see. It's not, it takes a little getting used to, but you'll see. So first things first, how is it different? All right, let me show you an example. So instead of S behaving the way we had before, this would be a single time step for the stock price tree. And you can see that S goes either up to SU, down to SD, or it stays where it is. And that's just S. And then we have three probabilities. The names are PU, PM, and PD for up, down. I guess this one could be thought of as middle. So we're allowing for the possibility that the stock doesn't move at all, which is the first time. And what's ingenious about this whole thing is that this branching structure actually can be altered. For example, you could also do it something like this. Let's say for some reason the stock is really doing well. It's possible to do this instead. And then so instead you've got, for example, this is just this plain old S. Okay, it goes up twice or the equivalent of twice, or stays where it is. Or you can also, if it's in a rough spot, you could have this. And if you're really, or if it's really important, you could actually combine these branching structures within the same tree. In fact, what often will end up happening is as the tree grows, especially with interest rate options, this is when this becomes so important. The thing about interest rates that makes them unique is that unlike stocks, which just keep going up and up and up, Like if you're, this is the Dow Jones for the last 20 years, it can just keep going up and up and up. Interest rates are completely different. They don't just keep rising or falling forever. When they get to unusually high levels, that starts to slow down the economy, and then the interest rates fall too. When the economy is struggling, interest rates will fall, but that will strengthen the economy, and then the interest rates will start to rise again. So over time, they may go through ups and downs, but they don't have a long-term trend up or down. Here we have a trend, which is of course positive, and it reflects the annual growth rate of the Dow Jones. Here, if there is a trend, it's just flat. So we go through ups and downs, but there's a tendency for them to always return to some long run level. It's almost like they're being pulled back to that by a magnet. So we have to take that into account when we model interest rate options. And one way we can do that is to, when the tree gets to unusually high levels. By the way, this one is very tricky to draw. I'm going to have to be careful here. If the branches are getting too high, then you might want to switch over to this structure down here in the bottom to indicate that they're not going to go much higher there, and if they're going to go down more likely than going up. And the same thing on the bottom. If it gets too low down here, we might want to switch the structure so that we force it basically not to go any lower by using the structure up here. So we can mix and match them if we need to. We're not going to start out with that. We're going to start with the basic case where we have the tree looks like this, just up, across, and down. And it turns out that that actually makes our programming job easier. You'll see why in a bit. But you can also see this is a headache to draw properly. Okay. So yeah, it's a bit much. And of course, you can see that it's recombining. It's called, when it goes up and then down, it's the same as going down and then up. And so, but if you notice too, as time goes by, the number of branches is growing pretty fast. With a binomial tree, it was just one more branch every step. Here, it's growing pretty quickly. So we have PU, PM, PD. Now, the formulas, they will give us risk neutral probabilities, but the way they are derived is actually fairly complicated. And we're going to need to do a little bit of a detour into this world of stochastic calculus or Ito calculus, just a very brief look at it, because the Black-Scholes model is ultimately based on this Ito's lemma, which basically explains how a random variable evolves over time. And so it has some very important properties, which we'll briefly touch on. But when we're done, in order to write code, we need what we will call a discrete time model of the asset that we're pricing. And we'll use that to implement our model. And then what we have to do here is show how the probabilities were derived. But you'll see it makes a lot of sense, but it's going to take a bit of detailed calculations. There's just a few restrictions. The three of them have to add up to 1. And now, one thing that they did have to do here was, remember in Cox-Ross and Rubinstein, by the way, oh, I forgot to mention, this is no longer Cox-Ross and Rubinstein. The researcher who put this together quite a bit later, as a matter of fact. I mean, once the Cox-Ross and Rubinstein model came out, people were happy because we had Black-Scholes for the European options, and we could use Cox-Ross and Rubinstein for either European or American options, although Black-Scholes is faster for European options. So you could easily imagine people using both models because they knew they were consistent with each other. This one came along quite a bit later, 1986, about 10 years after Cox, Ross, and Rubenstein by Phelan Boyle. And I mean, his interest in this was making a process available for more sophisticated options like interest rate options. And so this is his work. And just like with Cox, Ross, and Rubenstein, there's many different ways of going about this. His was the first, and it certainly was not the last. There's been many since then. They all make tweaks to it. They make different assumptions. They're all trying to come up with something a little better. But this is still a very popular choice for the trinomial model. And they're going back to the Black-Scholes model and following its process, which, as you can see here, we have this terrifying looking equation. And basically what this is what's called a stochastic differential equation, which explains how a variable evolves over time. And this was invented by a Japanese mathematician named Ito. We call this the stochastic calculus, or sometimes in his name, his honor, it's called the Ito calculus. There's a lot of discussion about this in Hull's book. Basically, it's different from what came before it because it allows us to, in effect, integrate a random variable. So that is something that wasn't possible before that. And so he showed the way that to do this. But for our purposes, what we're interested in is the idea that this ds is the instantaneous change in the stock price. And they're modeling it as two components. This is what we call a deterministic drift term. This is what we call a random volatility term. So there's what we're basically doing is visualizing the stock is behaving like this over time. There's a trend, and then there's this sort of random component which reflects the volatility of the stock. And so if you bring them together, what you're going to end up with is something like this. Okay, so in other words, there's a trend and there's also a random component, kind of like business cycles. There's a certain growth rate we have in the economy, but we know that the economy goes through peaks and troughs, and it doesn't tend to just grow at, let's say, 3% a year forever. That would be nice, but instead it tends to go through periods where the growth is very rapid, other periods where it's slower. So here we have something similar. The stock price goes through these ups and downs and ups and downs, but there is some long-term trend. So we're trying to capture both components of that with this stochastic process that we're looking at here. Now, what we need to do, well, you'll see what this is all about. This is going to be especially important, by the way, with Monte Carlo simulation. Okay, but we're going to need this to solve for the parameters of the trinomial tree. Specifically, we need this to figure out what to do about these three probabilities, because again, they have to be consistent with Black-Scholes. And now we made things a lot more complicated. So we have to find a way to find PU, PM, and PD in such a way that it replicates the Black-Scholes model. Otherwise, it gives us no value at all. It's like, who needs it? We don't need it unless it replicates Black-Scholes. So now, by the way, in this model, the DSs are differentials. This is the unique part. This Z is itself a random process. Um, DZ, which we'll see a lot of as we go forward, is something called Brownian motion. And basically, in a nutshell, this is a continuous time. I don't know if you've ever heard of this term before, random walk. A random walk is something we see a lot in statistics. Basically, a random walk is a process where we basically have a lot of up and downward movements. Now, I didn't draw it as well as I might have. But the logic behind the random walk is that think of this as the path followed by a random variable. A good example of this is like, imagine you're playing a game where you win $1 every time you flip a coin and it comes up heads, and you lose $1 every time it comes up tails. This path represents the value of your stash. If you start with zero, then you win $1, you lose. You win $2, you lose $1. This is showing us the progress of our winnings. Now, in a game like that, on average, you'd expect to break even. So the process tends to return to the zero. But so on average, the process, which represents your winnings, tends to return to zero. But what is changing, on the other hand, is that as time goes by, it can drift further and further away from the zero. So in other words, if you keep playing this game, you might get into some lucky streaks where suddenly you've made $10 or you've lost $10. As time goes by, that's more and more likely to happen. So the variance of the process increases proportionately to time. But the average is zero. On average, it should be zero. That's what we mean by random walk. Now, you may have heard of this. There's a very famous book by Burton Malkiel called A Random Walk Down Wall Street. He was the dean of the Yale Business School. And what he proposed was that stock prices are so efficient that you can't realistically make profits by simply watching their past prices like technical traders do. And so he compared the stock prices to a random walk in the sense that all this information is already incorporated into the price. So you'll find it very difficult to earn above normal profits without having other information available to you. But we're getting a little bit aside of ourselves here. But anyway, this is a random walk. A random walk can actually have a trend. The basic form does not. But here you can have a random walk with a trend. It just means that on average it's increasing. Same idea. Because it's kind of getting away from that origin. So here you have a positive trend. And of course, we can also visualize a negative trend. And you can have anything in between. So the point of all this is that the so-called Brownian motion that is part of this model, you can think of it as is a continuous time random walk. Okay, in other words, if you were to draw it instead of something like this, you would have something like that. Okay, so this is random walk. This is our Brownian motion. So you can think of it as a random process. Now, this couldn't be incorporated into a differential equation before Ito came along. You can only integrate deterministic functions with traditional calculus. So Ito kind of blew open the doors to all these other possibilities. And so he did win whatever is the equivalent of the Nobel Prize for math. But the reality is, it never occurred to anyone until Black-Scholes came along that it could be used for something in finance. In fact, that's why Robert Merton proved to be such an important part of that team. This was all his idea. He was the one who was on top of this stuff. And he explained to the others that, if you base your model on this, calculus, it could be easy. It should be easy to adjust it or update it for other types of options besides European call options. So anyway, things worked out for the best, of course. So the Brownian motion that is part of our model, the basic Brownian motion is just a continuous time version of the random walk. And so there'll be different versions of Brownian motion, but this is the basic one. And that's the one that you'll see represented in this model by DZ, because you just have to imagine this tells me how much the process is changing at a given instant in time. And so that's where the randomness from the model is coming from. And so we scale that by the volatility and the stock price. And so we end up with a deterministic component, the trend, and then the drifting part is coming from here. And the size of that drifting is proportional to the stock's volatility. Okay. So anyway, I don't want to get much more deeply involved with this just yet, because we have plenty more time to work on this next time we meet. But for now, I think we are off to a good start. Yeah, you can see we got to get ourselves involved with Ito's lemma just to understand what we're doing here. But this is a fairly short chapter. We're only going to do one or two examples with the code, and then we can move into Monte Carlo, which again I think is absolutely one of the most fascinating topics in this course. In fact, it's so straightforward. You can actually do it in Excel, but it's horribly time consuming. That's the only drawback. Otherwise, it would be used for everything. You might remember, I'll mention this again when we get there, but in the Manhattan Project, simulation was used heavily to study the properties of, subatomic particles. And so apparently, one of the physicists who worked on that project said to somebody one day, what we're doing here reminds me of the casinos in Monte Carlo. And suddenly the name stuck, Monte Carlo simulation. That's apparently where it came from. So, all right, anyway, we'll talk about that when we get to the Monte Carlo chapter. In the meantime, we'll stop here and then I'll see you next time. All right, good night.